this is going to be one of the biggest bull markets that is unfolding right now. Hey everyone, it's Paul with Investment Tuesday. In case you didn't notice, we are now on a monthly Investment Tuesday schedule. So there is a lot that has happened in between the last one and the current one. We have a war. We have a social media war that is, I can't remember any other war where the two warring factions are using social media in this way to control the narrative, to control markets as well, and to push prices in the directions that they want. So it is a absolutely wild scenario that is unfolding in markets now. AI mania is going on in full flow amidst all this. There are plenty of people pushing into the markets and buying into things, and stocks going up hundreds of percent. So we're going to try and cover as much of it as we can. And the main focus of this video, I'm going to talk about really the one investment that the war is kind of about. That I think like the long-term thinking behind this is not being discussed, not being talked about. And this comes from a guy that was telling you last year to buy oil stocks, right? So I'm talking about, you can take it with a grain of salt. You can let it go through 1 year and out the other. But I'm going to give what, in my opinion, is the bottom line insight of this war, which is going to, I believe, this insight anyway. I mean, the war, I don't know when it ends, hopefully soon. But even if the war ends soon, the main thing behind this, right? The main thing behind this, that is going to continue. That's going to continue. What am I talking about? Well, I'll tell you in a few minutes once we get through our legal disclaimers and disclosures, which is that this video, and the content from ATG Digital is not investment or financial advice. It's presented to you as opinion, information, engagement, or entertainment. Whatever you choose to do with it, it's your responsibility because it is your money. All ATG Digital content may contain errors, oversights, or mistakes. Understand that investment operations, buying or selling any investment, have significant risks and can lead to the loss of your principal. Bottom line, you could lose money. I, the owners, employees, contractors, ATG Digital, we own, trade, transact, and securities mentioned in this video, and all content from ATG Digital. We don't take money from company managements, crypto sponsors, or anyone else to recommend their stocks, crypto tokens, any investment. We are 100% independent. We have a new website. Go check us out. It is really easier to navigate. The plans are laid out. So go check us out. atgdigital.media is where you can find all of that information. Okay. Now, before I get into the main subject of this month's Investment Tuesday, I want to do a bit of an homage to a mentor. I'm going to get my notes here. A mentor, a guide, a teacher. I worked with this man, Murray Stahl, for many years, all the way from Bankers Trust and to Horizon Kinetics. And I was very happy to see that so many people, particularly on X, came out to recognize him, to talk about him. He taught a generation of investors like me on how to apply what Murray would call axioms of investing. And axioms to him were some things that, even if you change the situation, it still mattered. And I'm going to use that, in the analysis I'm going to do in the rest of this video. And he pushed us and asked us to apply these axioms to markets, investments, and also to life. Some of Murray's incredible insights, buying Bitcoin at 300, and understanding, what it represented at that time when most people were skeptical. Most people, thought that it was foolish. Murray, had incredible conviction. There is a stock called Texas Pacific Land Trust. I mean, you go look at it. It's like a 250x winner, over the last 10 years or so. Murray was buying that at pennies on the dollar when I worked with him, and would tell everyone about it. There are truthfully too many of these kinds of investments for me to go into. Let me say with sadness, he's gone too soon. He's going to be missed. Rest in peace, Murray, and God bless you. All right. Today's video and its insights are a little bit inspired by Murray. One of the things that geniuses like Murray and I'll say like Warren Buffett, they often focus on like very simple things, like often like a lot of the analysis that you see on social media. It's like, I don't know, there's pages and pages, but Murray, had a way of getting down to, the simple things. And scarcity is something that he really focused on, when I have to say vast majority of people didn't focus on it. So I mentioned that like Murray found Bitcoin very early, right? And that is probably the easiest and most dramatic illustration of how scarcity can create value, right? I mean, I know people will be like, well, Paul, Bitcoin's down 126 to 75. Listen, folks, again, using something that Murray talked about, he said, if you look at it this way, Bitcoin started out at zero in 2009, and today it's worth $76,000 against the dollar. So if you look at it that way, the appreciation against the dollar has been extraordinary, or the depreciation of the dollar against this finite, right? Commodity, currency, whatever you want to call it, has been extraordinary. So today, right? I said I started out with comments about the Iran war. I want to point out what, in my opinion, my judgment, is an entire industry that is setting up to rocket higher because of this critical characteristic of, I'll say, the vast majority of any really big, successful investment. All right. So let's get going on this, which is, I got a lot of notes here because there's a lot to this, which is like, and I've talked about this in previous videos, which is that governments around the world have been pursuing whatever you want to call it, net zero, green, no carbon, that kind of energy agenda for, I guess, depending on when you want to start measuring, 1, 2 decades, maybe 3 decades. And the way they've done this is that they've restricted energy, meaning, and by energy, I'm talking about fossil fuels, oil, gas, coal, the exploration for these, in other words, finding new reserves, new places where we can extract this energy. Production, which means, you got to get it out of the ground. And there's a lot of like things that you have to do to make it usable, the distribution, so pipeline, storage, all that stuff, right? They have restricted, like by environmental regulations, by all kinds of restrictions that they have placed. And so the supply of all of this has kind of stood still, as governments have just added and added and added, and, quite deliberately. None of this is accidental, right? I mean, this has all been done by policy, not as some big secret. And then that's on the supply side, right? And on the demand side, they've incentivized, behavior change, right? We own Tesla stock, and you can see that stock is up a great deal. And they've incentivized, right? EVs, you can get like subsidies or payments, etc. I mean, in Europe, some of this stuff, gets memed out, like, skip showers and, turn the thermostat to zero, sleep well, with very cold weather. Or, you can see every time you go to search for a flight, they tell you about these carbon credits, which is like to try to, dissuade people from flying or to buy these carbon credits. Bottom line, they've tried to incentivize you to stop using, right, energy. So now what we're finding out, by now, I mean, like, it is April 21st of 2026. As a result of this Iran war, what we're finding out is that the governments of the world were much more successful in sort of like restricting, the exploration, production, building infrastructure of energy than they were at the second part, which is, getting demand down. So, I mean, restricting energy on the supply side, they were pretty successful. I mean, all kinds of policies, all kinds of regulations, all kinds of laws, etc. But demand has, pretty much kind of like, maybe without those things, it might have gone up a lot more. But the demand, whether it be for heating your house, driving your car, flying onto your vacation, all of these things, yeah, that has continued to go on, right, at more or less the same rates that they did before. And as a result, what we're seeing right now, where you've got a war on and a crisis and a problem, which is that crude oil prices have jumped higher. Let's see. I have a chart here. Yeah, so this is Brent crude and West Texas crude. What's Brent crude? Well, that's the grade of oil that is traded in Europe. And what's West Texas crude? Well, which says light crude on my chart. Well, that's the grade of crude oil that trades in the United States in Texas. And you can see, on the, let's say, eve of the war, it's about 50, and now it's about 100, right? Okay. So crude oil prices have jumped higher. And then depending on what part of the world you go to, I'm sure we can, show dramatic illustrations of this. There are shortages of diesel. I was in Asia when the war got started. Actually, I was in India when the war got started. And I remember telling my mother, there's going to be a shortage of cooking gas because fairly soon after, a major liquid natural gas facility in Qatar was attacked, and they represent, I don't know, 10, 15% of global supply. And I was like, cooking gas is going to be short. Diesel is short. I was also in Southeast Asia, and you can go to places like the Philippines or Thailand. Diesel is short. Or in Europe now, we're finding out that jet aviation fuel is there potentially short. So people, of course, well, Paul, it's President Trump's fault. If he hadn't started the Iran war, none of this would happen. You know what? I don't get into politics. I know people love to want to get into this. I try to really essentially focus on what is going on, right? And while the Iran war is for sure the immediate catalyst for these shortages that have unfolded, the conditions for it, right, were set by very deliberate, very intentional long-term policies set by governments around the world, right? And anyone who is genuinely paying attention will know. And we have seen that, obviously, whether it be an incentive to buy an EV or to put solar panels on your house, or all these things. So the long-term nature of these policies mean that oil, gas, coal, fossil fuels generally are in the situation, I call it a perverse situation, where kind of there is Tesla sells, enough cars, and there's enough EV penetration in China, etc., where demand for, gasoline is falling, right? It's not like falling off a cliff, but it is falling. But the supply of all of these things, right, which starts with crude oil, which has got to be refined into, gasoline, diesel, jet aviation fuel. Then it also goes into plastics. It goes into fertilizer. The value chain from oil is extraordinary and incredible, right? So all of those things, that demand is not falling as fast as supply is falling as a result of all of the policy restrictions that we have placed, deliberately, intentionally placed, because we wanted less carbon, we wanted net zero, we wanted, all these things. So, yeah, and you can see this, here, this post. Let me make this a little bigger. This post talks about how oil demand is highly inelastic in the short run because most end users have few immediate substitutes. You can't really substitute anything for it. And I am going to tell you why it's not just in the short run. In my view, this is actually also going to be in the long run as well, right? And we'll get to that round. But as that post shows, I mean, the demand for gasoline, I mean, um, etc., the is inelastic, and with the war going on, with the Straits of Hormuz being, shut down, and anywhere between, I don't know, 15 to 20, maybe even 30% of crude oil, I don't know how much percent of liquid natural gas, essentially unavailable to meet demand, um, there's kind of like no place to go, right? And um, in the short term, like the post previously said, like, it's kind of understood, like, look, the Straits of Hormuz are closed, no tankers can get in or out. So all of that oil can't get to, whether it be Asia, whether it be Europe, or refined products, which, well, a refined product, takes crude oil and then turns into all these things that we use, right? Gasoline, diesel, jet aviation fuel, things for fertilizers, and all plastics, pharmaceuticals. I mean, you can just go on and on. Now, this chart here, which is taken from the International Energy Agency, shows you, kind of like where we were on the eve of the war, right? Because the war starts in February of 2026. And you can see we didn't really have a lot of spare capacity, right? I mean, so you can see OPEC, and this is crude oil production, just very basic. So you got 33.2 million barrels per day of capacity. And the spare capacity, as they would put it, is something, in the range of 4.6 million. So, yeah, that's not even close. So, if the total capacity, is about 33, there's like 6 or 7, maybe 8 million missing, depending on, how much exactly is offline in, you count Saudi Arabia, United Arab Emirates, Kuwait, Iraq. Iran's oil is also offline to some extent. They're getting some out. Oman, and then, and remember, Russia is somewhat curtailed as a result of the Russia-Ukraine war. So bottom line, there is a short-term scarcity, but here is the sort of like punchline of this video, which is that part is all understood. And in normal times, right, and in previous wars, Gulf War I, Gulf War II, etc., going back to this chart here, you see this spare capacity part. Markets respond to price. So as price goes up, normally someone somewhere is like, well, I got some oil, and we'll try to figure out how to get that to the market. But because of what I said, which is like, we haven't just restricted the exploration of new oil. We haven't just restricted the production of new oil. We've restricted refineries. We've restricted pipelines. We've restricted pretty much the entire chain of energy investments associated with it. So this is the insight and golden nugget, if you will, of this video. And what markets have not fully discounted, right? That there is no new supply that is going to come online, even as oil goes to, it's wasn't quite at 150, it was at 120. Let's say it goes to 150. Let's say it goes to 200. Let's say it goes to 300. There ain't no new supply coming online, because you know what? Yeah, you can't flick a switch and just get new supply tomorrow. This is something that would take a long time, but there are a number of reasons why this new supply ain't coming. And that would make oil stocks and oil-related stocks and energy-related stocks pretty much of any kind eventually, because, we've got essentially a break here, a gap, right? That has to be bridged by something. It ain't going to be bridged, at least based on my analysis, by oil. It's not going to be really bridged by natural gas, which is another fuel, but, that's liquid natural gas. So it's not going to be bridged by coal. So we'll have to figure it out someplace, and we'll get to this. All right. So why is no new supply coming? Well, number one reason I got here: governments around the world having pursued this policy for 15, 20 years and persuaded their populations that this was the right thing to do, are not going to want to admit that their policies were wrong. And truthfully, there's nothing they can do short term to change it, right? I mean, you can't get oil companies to just go discover oil tomorrow sufficiently to make up the gap, right? Then there's other sort of like behavioral things that most people and the market still haven't yet, cottoned onto, which is that energy companies, after being restricted and regulated to cut production, have no real desire, no incentive, if you will, to increase exploration, which would take years. I mean, you got to go find the oil, make sure it's there. Some of it is like, in like crazy places, deep under the ocean, in some wild area, which is, difficult to get to, all sorts of environmental regulations. Bottom line, it would take years if it were possible at all, but essentially they don't want them to do it. No laws have changed as a result of this war. So after 20 years, my thinking and my insight is this, which is that oil companies, energy companies have internalized this net zero, green, no carbon, view of the world themselves, right? And they are like, well, our goal is not to increase production. Our goal is not to increase exploration. Our goal is to essentially kind of like maintain what we have here. And so when you have prices jump from 50 to 100, what are they going to do with this money? Well, they're going to use those profits to buy back stock and pay dividends. They will also buy each other, consolidation, right? Up, bidding the prices of these companies higher and increasing their magic word, scarcity. There's going to be fewer and fewer companies, and you'll have to pay more and more to control them, because they are not really going to spend their money to increase oil, because that's no longer the purpose of these companies, really. I mean, they have like let that go. That is not something that the market has fully like really gotten to understand. And I believe they will. They will understand that. It will come slowly at first, then suddenly later. And the other place where they'll, actually oil companies are putting their money is actually into new energy. They're making investments in solar. They're making some investments in lithium and all these places. So that's where, their money is going. And you're like, well, Paul, that's good. It's all going to, yeah, except that those things are kind of long term. Well, and by long term, I'll say on the low side, 5, 7, 10 years. On the high side, 10, 20, 25 years. All right. So there is a big gap, of time where we need energy sources. And yeah. All right. The last thing I'll say is that their workforces have also degraded, or they've lost personnel that have certain skill sets. Technology companies have not pursued, the last big technology like breakthrough in energy was now about 10, 15 years ago, which was shale oil and fracking, which of course was controversial, and people tried to shut it down around the world. So, a lot of those skills have been abandoned. The people who know how to do that are few and far between. Wildcatting, which is, searching for oil. It used to be done. It used to be a big thing. To be rewarded by governments, rewarded by the markets. Those are all gone. So nobody really is there to take the big chances, risks that would deliver our new energy. Bottom line, energy companies will simply buy back stock and pay dividends as energy prices rise. And being that they're not exploring, my view is this, which is like you will see oil higher. I don't know exactly the schedule when it gets to back to 125, then to 150. But my view is that we are now in a scarcity situation for oil. And governments that, say, well, we're going to tax their profits, regulate their profits. You're going to see what happened sort of like in other industries where there was a policy restriction and where, on some level, the demand was inelastic. I mean, if you think, like, if you go and look at tobacco stocks, for example, those stocks ripped higher because even though the demand went down, they raised prices faster. And so they continued to make money. They didn't expand their business, obviously, because it wasn't allowed, but they went buy back stock, and their stocks were huge. Now, I've never invested in a tobacco stock. I'm not recommending tobacco stocks, but the same scenario, in my opinion, is about to unfold, which is that you attempt to tax them, take away their profits, it'll just end up being passed on to consumers. So there's no new supply coming. There's no new competition coming in the short term. The new energy, which is, the alternative, which is, solar power, batteries, lithium, ion batteries, nuclear power, geothermal. These are all things that will take multiple decades to roll out to replace fossil fuel energy, which we need today to run our lives. So bottom line, in terms of the investment insight, is that oil stocks and energy stocks are in a long-term structural bull market, right? I mean, let's just put up two ETFs, XLE and OIH. These are two oil ETFs. OIH is the oil services sector. And you can kind of see the sort of like the value destruction that policy restrictions on energy companies has wreaked on these stocks. The green line is oil services. The blue line is pretty much all oil companies, and it's dominated by companies like ExxonMobil. And you're like, well, Paul, these have gone up a great deal. Yeah, but compare that to technology stocks. Compare that to the S&P 500. The energy companies have definitely they have definitely lagged a great deal, right? So my view is this, which is like, well, even this year, like the number of companies have shrunk. The companies that explore for new energy has shrunk even further. The number of oil services companies that they've consolidated and shrunk. Bottom line, this entire industry is one big gold mine of scarcity. All right, and there is no real sign that anything is going to change because the demand is, let's say, for the next 7, 10, maybe even 15 years, inelastic. And by inelastic, mean that you just need it. Like, I mean, there's no real way to shift, what we do away from it. And then the supply, which is kind of like also locked in place, and which by function of long-term policies and decisions at the governmental level, and now which has been, transmitted through the industry, the company level, it's kind of like also locked into place. So while everybody's like super, excited about AI, I would say, I mean, one of Warren Buffett's bigger investments over the last 10 years, he's bought up something like 10 or 11% of Occidental, which is an oil company. And what are they doing? Well, they're buying back stock, right? That's what they're doing, right? So this scarcity play in energy and oil, I think this is going to be one of the biggest bull markets that is unfolding right now. If you're at ATG, we started buying oil in 2025. We're up, I don't know, 25, 30, 40%. And yes, there has been volatility associated with this war. That's there in every stock. But for me and my view, I've laid it out for you, which is that this war is not really the big story for oil and energy. The big story is that we are now understanding that those energy sources are scarce and fading out. There's nothing much we can really do. And that means, in that scenario, oil companies, which will see higher prices, they're going to make more money. And as they do that, they will buy back stock to make their companies shares more scarce. They will buy other companies, which makes companies in the sector more scarce. Bottom line, it's an enormous, I don't know, lollapalooza of scarcity that is going to drive, these stocks higher and continually higher, and people will not come to this understanding very quickly. So there'll be plenty of incremental demand as this unfolds, and as I like to say, that's what pushes prices higher, right? It's not like writing books of research that do that. It's demand, right? It's demand by investors to be like, oh, I get it. And now they start to allocate capital, buy these stocks, and are constantly there bidding them higher anytime they go down. That's how bull markets happen. That's how big gains happen. And that's how you make big money in your portfolio. If you want to see what oil stocks we have in ATG Digital portfolios, atgdigital.media, that's where you should go. And with that, I am going to close this month's Investment Tuesday. Say thank you for attending. This is Paul saying